Okay, let's get right into this. Welcome to The Explainer. Today, we're putting on our equity research hats, acting as investigative financial journalists to literally tear down one of the messiest, most polarizing earnings reports of the entire year. We are doing a full financial autopsy on Coupang's second quarter of 2026.
But before we dive into the numbers, we have to get this out of the way. Disclaimer. This is an educational case study and quantitative analysis for informational and entertainment purposes only. It does not constitute financial advice, investment recommendations, or an offer to buy or sell any securities. Past performance does not guarantee future results. Please consult a licensed financial advisor before making any investment decisions. All data is sourced from publicly available filings and is subject to fair use for commentary and criticism. All right, let's look at the data.
So here's the multi-billion-dollar question we have to answer today. Is Coupang cheap for a reason, or is it cheap enough to own? We're staring down a massive sell-off in the company everyone calls the Amazon of South Korea, and the stock has just taken a serious beating. Our job here is to figure out, is this a structural failure in their business model, or are we just looking at a mispriced opportunity caused by a total nightmare of bad headlines?
To give you an idea of just how divided the market is right now, look at this massive disconnect. You've got the current trading price hovering down near 52-week lows, around $16.19. But then you look at Wall Street analyst targets. The average is nearly $24. And Barclays, they've set a target of $30. I mean, if the bulls at Barclays are right, we're talking about an upside of roughly 85%. So what exactly is Wall Street seeing that the broader market is completely missing? Section 1, Headline Disasters and Red Flags. Let's start with the surface-level noise because Coupang was hit by 3 distinct, isolated shocks, all in the exact same quarter. Talk about a perfect storm. First, they got slammed with a $410 million administrative fine from Korean regulators over a data breach. Second, a massive fire at one of their fulfillment centers literally wiped out $246 million worth of assets and inventory. And third, the Korean won weakened to its lowest level against the dollar in 15 years. That created a brutal $548 million foreign exchange headwind. Put them all together, and these 3 things absolutely cratered Coupang's reported operating income. And the fallout? Well, it's pretty clear. The gap swing here is honestly terrifying on the surface. They went from a healthy $32 million profit in the second quarter of last year straight to a staggering $500 million net loss this quarter. Now, when retail investors see a $570 million loss on a headline, what do? They panic and hit the sell button. But as financial investigators, we know that $410 million of that loss is tied directly to that regulatory fine, which, by the way, management is planning to appeal. Honestly, though, what's even more concerning to me than the gap loss is what's happening to their cash. Trailing 12-month free cash flow absolutely plunged from $784 million down to just $105 million. This isn't some accounting quirk, right? This is actual physical cash. And it's being driven by 2 things, the lower profitability from those disruptions we just talked about, and significantly higher capital expenditures, which we are going to break down in just a second. Section 2, Underlying Growth and Green Flags. Okay, so the surface looks like a complete disaster zone, but let's step past that. First, we've got to fix the revenue distortion. Because of that historically weak Korean won, reported revenue growth looked super anemic, just 4%. But when you strip away the macroeconomic currency fluctuations, which, let's be real, management has zero control over, you look at constant currency. And on a constant currency basis, the business is actually growing at double digits. 10% underlying growth means the core engine is still very much running. And honestly, that engine is running hot for their loyalists. This quote from CEO Bohm Kim is absolutely critical. He points out that if you exclude the customers who left during the data breach and just haven't come back yet, the spend of literally everyone else is growing at 16% year over year. That perfectly matches their growth rates from before the whole disruption. Plus, management noted that returning WOW members aren't just coming back, they're actually resuming their spending at record highs. We can actually see this resilience right in the active customer counts. Back in Q1, right after the data breach, they saw a pretty concerning dropdown to 23.9 million active customers. But look at Q2. Boom, a clear reversal, bumping right back up to 24.7 million. This really proves that the hit to customer trust might have just been a temporary blip. The core is stabilizing.
Section 3, the cost of expansion. So remember earlier when we saw that free cash flow drop off a cliff?
Well, here's where they're aggressively burning that cash. It's in their developing offering segment. This includes Coupang Eats, their streaming service called Play, and crucially, their massive international expansion into Taiwan. Now, this segment is growing incredibly fast. We're talking 24% in constant currency. But it comes at a steep price, nearly $1 billion in projected adjusted EBITDA losses for the full year. This isn't an accident, guys. It's a deliberate capital allocation choice to fund their overseas logistics.
And this timeline explains exactly why they're spending so aggressively. Coupang is basically exporting its entire playbook. Look at this. It took them 4 agonizing years to build the infrastructure in Korea before they could finally launch their famous Dawn delivery service. But in Taiwan, it took them exactly 1 year. 1 year. They're scaling so much faster because they're leveraging 15 years of existing technology, systems, and operational data. They aren't starting from scratch. They're copy-pasting a proven, highly efficient machine.
Section 4, Assessing the Economic Moat. Which brings us to arguably the most important part of our autopsy, defining the economic moat. When we put this through a standard moat analysis, we're seeing expanding advantages across 3 key pillars. First, network effects. As they build out this end-to-end logistics network in Taiwan, more selection brings in more buyers, which in turn justifies even more infrastructure. Second, cost advantage. Management specifically called out AI as a multiplier here, using their 15 years of physical data to compound productivity and lower the overall cost to serve. And third, intangibles. Their WOW membership program continues to lock in incredible loyalty, even despite a major data incident.
But if you want to know the true power of their moat, it all comes down to one specific metric: wallet share. Even their oldest customer cohorts, I'm talking about people who started using Coupang a decade and a half ago, are still compounding their annual spend today. They are spending nearly 10 times what they spent in their first year. As Coupang adds more selection, like groceries, luxury goods via Farfetch, food delivery, they simply capture more and more of the customer's wallet. Section 5, the final verdict.
All right, let's wrap this up. We've looked at the headline disasters, the underlying data, the cash burn, and the moat. Let's deliver our final verdict on this incredibly polarizing earnings report. The objective data actually suggests that Barclays might be right on the money here. If you strip out that one-time regulatory fine, the horrible luck of the fulfillment center fire, and the macro currency drag, the core compounding machine remains completely functional. Management fully expects their margins to return to pre-incident levels by mid-2027 once they grow back into their fixed capacity costs.
So the surface-level financials look disastrous, and balance sheet equity definitely took a hit. But the underlying operational metrics, that 16% active cohort spend growth, the 10% constant currency revenue growth, and the rapid scaling in Taiwan, they show intense resilience. The models are pointing one way, but hidden flags suggest a storm. So which side of the trade will you take? Is this a permanently impaired business or the ultimate mispricing? Take these facts, dig into the filings yourself, and do your own homework. Thanks for joining me on this explainer, and I'll catch you next time.